Hi there, welcome to today's edition Understanding Liability in Business Management. My name is Selom Adade. I'm a governance, risks, and compliance professional and also a corporate trainer. So, today we are discussing how organizations, how business owners, shareholders can understand liability in order to protect them from financial and legal risks. Imagine this: you own a business which is doing well until one day some of these things happen. One, the business owes suppliers, the customer sues your company, or the company cannot repay a loan it took from the bank. What happens when these things occur? Who is liable? Who should pay? Is it the business? Is it the owner? Or both of them? One powerful concept businesses can appreciate and understand is the concept of liability. What is liability? Liability refers to the legal and financial obligations a business owes to other parties as a result of its operations. So you can call it money, debts, or obligations that are due that businesses must settle. So far as you are in the business, you are in the value of creating, there are some things you'll be liable to. So popular examples of liabilities are loans, rentals, subscriptions, taxes, employee salaries, supplier payments, legal claims, lease obligations, among others. These liabilities, when they are managed effectively, they maintain financial stability, they ensure the business is protected, you are able to meet legal obligations, you are able to access key services such as loan and investment and funding, and also be able to avoid lawsuit, insolvency, and be within the lines, within the risks, and we are having good positive goodwill. But when an organization is not able to manage its liabilities when they are due, what happens? It affects cash flow, it affects solvency, bankruptcy, there is lack of goodwill, lack of investor confidence, and it can also even lead to lawsuit, class suit, legal fines, among others. So these liabilities can be grouped into two. They can be grouped into current liabilities and non-current liabilities. Current liabilities are liabilities, debts that are due within a year. So they could be staff salary, short-term loans, tax payables, statutory payables, account payables, among others. These things that are due within a month, within a year, we call them current liabilities. And non-current liabilities are those long-term liabilities that are due over a year period. So there could be bank mortgages, debentures, long-term loans, lease obligations, rental agreements, deeds, among others. These liabilities, an effective manager, business owner must ensure that they manage it well. So by managing these liabilities, you are able to ensure you are continuing to be in business, you meet legal obligations, and your reputation is on site. But in understanding what is liability, look at this scenario. ABC Enterprise purchase inventory worth 8,000 cedis on credit. The supplier expects payment within 45 days. So the supplier expects payment within 45 days. So is this a liability that is current or non-current? By using the tenure or time when the money is due, we can group this liability into a current liability because we have the view that it is within a year. For business owners, for stakeholders, for shareholders, or someone who wants to open a business or who wants to develop a business or register a business, one thing we have to appreciate is which type of business structure are you choosing. So we call it legal form of liability. So in the opening question, I asked a question that when something happens to your business or when you are liable in your business, who pays? when something happens, when your suppliers fail, you fail your suppliers and you are owing your suppliers, or when a customer sue you, or when you take a loan and you are not able to pay them. So for someone who wants to start a business, for someone starting or managing a business, one way to understand whether you are liable or not is by understanding the legal forms of liability. The legal structure of a business helps us to appreciate who is responsible for debts when it happens, who bears the legal risks when these events happen, or whether the personal assets of such directors, such proprietors, such owners, such investors are protected or not. So by understanding what is limited liability and unlimited liability, we are able to appreciate whether this form of business structure I'm trying to do, when something occurs, am I responsible? Will I bear the legal risks, or are my business assets protected, or my personal assets protected? So we start with limited liability. When we say a business is liable limitedly, we are saying that the owners, the shareholders, the investors are responsible for only the amount invested in the business, or only to the number of shares they've paid. So when something happens, the company is treated as a separate legal person. Here, your personal assets are protected, your investments are also protected if the business fails, but you are responsible for only the amount of investment that you have invested, or the amount of shares that you have bought into the business. So here we say that you are a limited liability investor. One example we can use is SmartTech Limited. So SmartTech Limited owed 5 million cedis. The company later became insolvent. The shareholders invested 100,000 each into the business. So the question we are asking is, can creditors seize shareholders' personal homes? The answer is no, because SmartTech's business structure is a limited liability. So only the company assets can be used to repay the debts. So here, when the bank wants to go after SmartTech Limited, it is not going after the investors or the shareholders, but it is going after the business. So that is one thing we have to. Then the next one is unlimited liability. Here, the owner and the business are legally the same, or they are one. There is no separation between personal assets and business finances. If the business cannot pay, if the business is insolvent, this happens, the shareholders' personal savings, personal vehicles, land, houses could be used to settle the payment. So the receiver will take all these payments and forward it for liquidation. A key example which occurred was Kwame, who operated as a sole proprietor. The business owed suppliers 250,000, the bank 400,000. The business owned assets worth 150,000. Who pays the remaining debt? In this scenario, Kwame is personally liable because his business legal structure is unlimited liability. So his personal property will be added to his existing 150,000 in order to clear the debt that is owned by the suppliers and also the bank. So we are saying in summary that liability is very, very important for businesses, but the businesses must understand the structure they are in, whether it is unlimited and whether it is limited. And if your business is unlimited, appreciate that when something happens, or when you are liable, or when an obligation is due, your car can be taken, your land can be taken, your house can be taken, your personal assets are not protected. But when your business is a limited liability, your business assets are only used, but your personal assets are protected. This alone is a game changer, and it changes how businesses and decision making take. So for a limited liability, it is suitable for companies and also guarantees among others, and also for unlimited liability is suitable for sole proprietorships and partnerships. The difference is that for a limited liability, your risk is limited to your level of investment. For unlimited liability, the owner bears all the risk. For a limited liability, your personal assets are protected. For unlimited liability, your personal assets are risks. Our key takeaway is that every business has liabilities, and these liabilities can be either short term or long term. But understanding their timing is very essential for managing our affairs well. But one key thing organizations, shareholders, business owners must appreciate is that they must choose a structure that aligns with their goals and risk appetite. So whether you are risk averse, risk neutral, or a risk lover, then you know whether you can go into a legal structure which is limited liability, or you can go into a legal structure which is unlimited liability. This alone will let you know that when your business structure or legal structure is a limited liability, you are able to protect your personal wealth, whilst when it's an unlimited liability, your personal assets are at risk. By knowing this difference, you are able to know how to invest into the business and also how to protect yourself. Effective liability management strengthens the business sustainability, stakeholder confidence, goodwill, business viability, and long-term success. I end by saying that good business decisions begin with understanding your legal responsibilities, managing your obligations, and protecting what you've worked hard to build. My name is Selo Adade. I'm a governance, risks, and compliance professional and a corporate trainer. Thank you for listening to this edition. I hope you found value in it. See you in the next edition. Stay safe.